Hey guys, so yeah, as Matt was saying before, everyone had to start somewhere, right? So when I was first starting out, it was definitely a little scary at first when I was trying them out. I wasn't doing credit spreads when I first started out either. I was actually doing covered calls for quite a bit. Um, I just accumulated a lot of shares of stock over many years. Once I had 100 shares of stock, I realized you could sell calls against it and get decent premium off it. And then the stock price also was a lot higher than it was when I bought the shares. So I figure you might as well look for a good place to close the shares out and get some premium on covered calls. But yeah, doing spreads is a different definitely is a learning curve to it, and also could be a little scary at first. That's why, as Jolly just said, I definitely recommend paper trading, especially if you're brand new to these things, just so you can see how the mechanics work out and how to place the trades properly and see what happens to the trades when they work and when they don't work. Right? Got quite a few coming in here. So I'm going to leave it open for questions at this point. I don't have anything prepared. Just wanted to help you guys out as you have questions on how to place the trades, the reasons why we do the trades the way we do. So floor is open for you guys. Don't be shy. Ask questions as you have them.
Lance, I have a couple questions if I could.
Yeah, go ahead.
All right, I wrote these down, so I better
That's fine.
get these right. So I'm interested in the stop loss, right? When you send out your trade.
Okay.
So I just want to make sure I have this right. So when you list a stop loss and it says stop one or stop two,
Yes.
that's essentially stop one is basically $100.
Yes.
Stop two is basically $200.
Exactly. So when you're looking at stock, they always involve or options, they always involve 100 shares of stock. So whatever number I'm putting there, you just times it by 100. Like if it says stop at say zero point 0.8, you just move your decimal point two places to the right, and that'd be a $80 stop out.
$80
One
stop loss.
one is $100 stop out, and so on. So just to keep the numbers relatively straightforward, let's say we started a trade at zero point 0.3. That means you're taking in $30. And
Right.
then we're usually going to stop out at zero point 0.9. I usually like at a 3x stop in most cases. So in that case, you would have taken in $30 when you started the trade because you started at zero point 0.3. And then if you stopped out at zero point 0.9, you would lose $90. But the difference would be the 30 you gained minus the 90 you lost. So it'd be a
Right.
$60 total loss in that case. It's essentially a 2x loss on your trade when that happens. Okay?
Got it. And then you also sometimes put, I noticed in one of them you said you posted point 0.5 or better if you could get more.
Yeah, right.
Stop at 1.5. So
Yes.
when I do the math, it's 0.5 times plus 1.5. So the stop would be 2
No, the stop is just what I'm writing. So if I write 1.5 as a stop, that's where we're going to stop out of the trade.
total. That's it.
Yeah. So essentially, whatever you're taking in, times it by three, and then
And
that'll be
that's
the
the
stop loss. Now, I do or better because sometimes you won't take the trade or get into the trade the same time I do. You're busy with working and whatnot. So if you get in the trade a little bit later, the premiums could be a little bit different. That's
right.
why I put the first price as a reasonable price to get. It's pretty much always going to be a little lower or a decent amount lower than what I got on it, just so people are able to get into the trades. I want to make sure that people are able to enter them, even if they're busy.
And then one last question I have for you is on the longer term trades.
Yeah.
You advise, and you mentioned it on your video, and I saw it in some of the ones you say you advise setting an alert on a specific stock price as
Right.
better option than entering a stop market order
Right.
straight. Can you explain why that is? I
Yeah,
guess.
it's a good question. So when you're doing these longer dated trades for individual stocks, sometimes other traders will come in and then put really high or really low orders in for a certain price. So if they do that, suddenly the bid ask spread, the difference between the two prices gets a lot greater. And if it's a stop market order, the brokers is going to look into it and see like, oh, suddenly the current premium is going to be way higher than what you took in because of those like rogue orders, so to speak. And then in those cases, you could actually stop out on the order,
Right.
even though the position is perfectly fine. And that has happened to other members before. So it's not very common, but it does happen. So that's why you want to be aware of it. If you're really busy and you're not able to track it with the alert price, you could put in the 3x stop. It's still a safer way to go. It will usually work, but it's not always going to work. So that's why I'm leaning a little bit against it and just doing the alert price.
And the alert then, so you can go look at, once the alert happens, you can go look at it and make an assessment at that point, whether you want to
Exactly.
get out or not.
Yeah, exactly. Now, typically the alert price is going to be a little bit higher than the sold put because we don't want to make the alert price at the sold put or close to it because then you're getting close to the max loss scenario. And if you do a 5 lift spread, you could lose $500 on that trade. And the whole strategy pretty much breaks down at that point if we're, maybe making say 40 or $50, but then losing 500. It's almost like picking up pennies in front of a steamroller. A lot of traders say, you could get those pennies quite a bit, but that street steamroller's moving and you don't want to get squashed by it. So that's why I personally do the stop orders and or at least alert prices. Now, typically with the alert price, if it gets and it hits the alert price pretty quickly right after we enter the trade, it's going to be more than a 3x stop at that point because you still have a lot more time for that option to get to that price. And you didn't get a lot of the theta decay yet. So just be aware of that. If the alert price happens much later in the trade and there's say a week or so left, we might even just stay in the trade to see if it still works out. I'll just keep a
Right.
close eye on it and then we might actually work out. That has happened before. So that's more of like an art rather than a science part of this, where I personally would rather just watch it, monitor it, and then see what happens. And usually it's not a huge difference in the end. Good
Hey, Lance, I
question.
got a question for you.
Yeah,
Have you ever had, and this is probably more on a zero DTE, when I traded them, there was times where it could blow through your stop.
yeah,
Um, I just wanted to throw that out there for people that have never traded it.
yeah.
It is something to be aware of.
Right. That's why I would prefer if you're using Thinkorswim, you can do the stop market order, and those will fill almost always at least very close to what your stop order is. It might be 10 or $15 higher, possibly, but there's a pretty low chance it's going to be, 100, $200 different. If you're doing a stop limit order, though, like on Tasty Trade, unfortunately, they don't do stop market orders. In a stop limit order, you're going to want to put your stop price at that same 3x stop that I write. And then the limit price, you want to put quite a bit higher just to make sure you get filled on it. So the way it's a little more advanced here, but the way that that works is, let's say I had a stop limit order at say 1.5, and then the limit is like 1.6 or so. If zero DTE trades move very dramatically, like you have a big red candle or green candle, and it goes against us, it could go right through that limit price. And then at that point, you don't even have your stop order in, and it could just keep getting worse and worse.
Right.
So that's
Right.
definitely things you want to be aware of. For Tasty Trade, if I'm doing it, I will do my limit price at least $50 higher than the stop price, just to make sure it turns into the market order once it actually hits, the stop price at the end.
In TradeStation, sometimes when it gaps, it could
Yeah,
skip.
exactly. Yeah, if it gaps, it could go way past the stop price. That hasn't personally happened to me before, but it has happened to members before if you do a stop limit order. Stop market order will trigger once the premium is at the price that you put. So if the brokerage like Thinkorswim sees you put a 1.5 stop market order and it touches 1.5, it closes it out. Sometimes you actually close out less than that because the market might have just stabilized right when it touched the stop, or it might have reversed a little when you touch the stop. It essentially tries to find the nearest order and it just takes it right away. It doesn't, you know, wait for a certain price that it wants. That's the main difference between stops and limits. Yeah, quite a bit actually for Thinkorswim. Like I'll put a stop at 1.5 and I might close out and stop at 1.3, 1.35 because it just reversed a little bit. So it's a kind of a slightly mixed blessing there. You didn't lose as much as you could have. All right, floor's open. Questions? Victor, you have any others?
Yeah, I have one other one. Since nobody's asking anything, I'll go ahead and take advantage of it.
Okay.
So I'm interested in the strategies you're using because I'm not that familiar. I've done credit spreads, I've done debit spreads, and I've done butterflies, but never
Okay.
quite in this way.
Okay.
So when the market is ranging, right?
Yeah.
When it's in compression, when it's in a squeeze, like today. Today was mostly a sideways day at the
Yeah.
bottom of the SPY pre-market. Uh, any of the three techniques you use will work, right? At that point, you basically win when the market goes sideways.
Pretty much, yes. So if we're selling, let's say the stock is at $200 a share and we're selling like a 180 put, buying the 175 put right below it. If the stock stays at 200, if it goes up any amount, if it drops a little bit, but doesn't go close to the 180, then you would win in all those situations. Now, the times that it doesn't work is when it drops pretty quickly and it gets close to that 180 that you sold. So we're
And so,
essentially playing many different directions, and only one direction can really hurt us.
and in the mornings when you decide whether you're going to use a call credit spread or a put debit credit spread or even an iron condor,
Yeah,
you're trying to determine, is the market going to trend upward? Is the market going to trend downward?
pretty much,
Or is it going to
yes.
go sideways?
Exactly. Pretty much that's what I'm looking at. Main things I look for is in the pre-market, you could go to the futures. If you just type /ES, that is the SPX for futures market. And those are open before the market for SPX is actually open. So at that point, you can see the trend in the pre-market session. And then it usually gives away where I'm going to usually pick. So if the market, like today, was down about 0.8 or so percent before the market even opened, it was pretty obviously a downtrending day, at least to
Right.
start. So that's why I went call credit spread. I went the opposite direction.
And the
If the
market did drop on open and then it
Yeah,
just went sideways, right?
exactly. It dropped it open, and if it stayed where it was or went down any more than that, we're still good because we sold the call credit spread. So if we're down here, we want it to stay here or go down, or maybe if it goes up a little bit, but not close to our call credit spread, we're good on it. So that's why there's many different ways we can win on these trades in the end. Just thinking about these based on probabilities, we're most likely going to win anywhere between 80 to 90% of these trades in the end. And then if you're making, say, just get a ballpark $35 or so per trade, but you stop out at say $100. So when you just think about it based on the numbers, for every 2 wins you get, it offsets one of the losses. Because let's say you take 35 in one trade, another 35 in another trade, you're up $70 on those two. You're going to lose about 70 in the stop loss. So essentially, you want to be about 66. It's actually slightly more of commissions, around 68 to 70% of the trades. If you're winning about 70% of the trades, you're pretty much at break even in the ends. But we've been showing long-term results of about 80 to 90%. And then if you just think about it as probabilities, each trade is just a separate trade. And then the laws of averages will work out in our favor over time. And that's the main way that we actually work on this.
And that's the delta number you give out, right?
Yeah. So
my understanding of delta was always on an option, a delta of 45 or 50. That's how much you make if the move is $1 up, right? But your
it's the
point is the
technical.
delta is the percentage that you stand to win.
Yes, it's a approximation of it. Your first thing that you said is the technical definition for delta, which is technically what it is. So if you have a 0.3 delta and it goes up $1, you would make 30 cents essentially.
Right.
However, when you look at long-term averages and probabilities, it is a close approximation to the percent chance it will get to that
Right.
strike price at expiration as well. So yeah, if you're selling like a 0.1 delta, you know, 100 times, you're going to win 90 of those and lose 10 of those on average. However, our numbers are going to be a little worse than that because of our 3x stop. So we're getting out of the trade a little bit earlier than waiting until the whole day. So you got to lower those percents a little bit because of that. However, it's usually not 20, 30% different. You know, it's usually going to be much better than that. So good questions. All right, floor is open. Anyone have any questions? It's teacher office hours. I just hang out and you guys ask.
If you manually want to close something, do you close both your positions at the same time?
I personally do because I just want to get out of the position completely. Some people will close one leg at a time. Like they might only close, let's say we did an iron condor, you saw the put and call credit spread. And let's say market shoots up, our call credit spread is definitely challenged. You could close just the call credit spread, leave the put credit spread on the rest of the day and let it expire worthless. However, you're not really looking at that much money in the end. You might be making, you know, $10, $15 possibly. And when you look at the stop order, if you're stopping out on the whole thing compared to stopping out on just the challenge side, it usually ends up being very close anyway. So that's why I personally just get out of the whole thing. But you could consider closing one side that's challenged. I would not close the unchallenged side. I'd close the challenged side, by the way.
Okay, thank you.
Do you wait until 9 o'clock to make the call on the SPX ones just to give yourself a little more of a feel for the day, what's happening in that first half-hour burst?
Do you want to hear a good, like, professional answer or the actual answer? It's a little bit of both.
Either one.
The professional answer is yes. I wait until 9 o'clock to see where the market trend is. The actual answer is I have PLC, which is planned learning time, where I'm working with other teachers and how to be a better teacher during it. And I'm pretty busy in the first 30 minutes of the day, so I can't really make the order then anyway. So that's why I wait. See, I'm very
Okay.
honest with you guys. That's not
So
to
there's
say I
not,
don't look at the market during it sometimes, because you might see me posting while I'm supposed to be working with other teachers, but you didn't hear that.
so if you get a pretty good feeling for what's going on based on futures, there's nothing wrong with putting in your spread at 8:30,
Yeah.
9:30 open, whatever time zone you're in.
Yeah, that's fine. The one thing to consider though is there's sometimes news events that happen at 9 o'clock. So if there's a news event like unemployment numbers or
Yeah.
blah blah blah, then you might want to wait a few minutes just to see what happens because that could turn the market sometimes.
I'm usually pretty cognizant of that, but once in a while there'll be something where I lost my focus. So it's
Right.
always good to remember.
I'm posting on the chat a website called forexfactory.com. This is a good place to find any news events that's happening. I check this when I look at the pre-market also. Quite a bit of times it's at 7:30 Central Standard Time, so an hour before open. They'll show some economic news. So that's why I wait to say where I'm thinking of until after that. I usually try to tell you around 30 minutes before they open, just to see what's happening there. Sometimes you could kind of tell, like today, there was no huge news events that I was aware of, and the market was already down, before it. So in that case, yeah, you could enter it early. If you want to, you could enter in a futures credit spread before the market opens if you want. You could
Oh, okay.
consider like an ES call or put credit spread or iron condor. Pretty much the same width, like a 10 width is gonna be the same amount of buying power. Don't quote me on that. I think it's the same, but it's gonna be very close to the same amount of buying power as what we do anyway. So if you want to get even earlier, you could.
Okay. Yeah, I haven't sold anything on futures yet. I've just been doing
Yeah.
the ones in stocks.
But you could easily sell a put call credit spread on ES futures. You could change the widths. You don't have to do a 10 width. You can look into a lot of different strategies for that.
Okay. Maybe I'll test that in sim a little bit and get used to
Yeah.
that.
Yeah, like today, if you got in around an hour before open and sold the call credit spread like I did on, say, ES, you would have done fine too. You might have made slightly more because the premium would have decayed a little bit longer. Possibly, it's hard to say. I'm not talking a ton of money here. There might have been 10, 20 bucks more, possibly.
Is it 10 wide? You got a $10 difference between your two picks? Or
Yeah, for
5 wide,
this,
a $5 difference?
yes. The width of the spread minus the credit you take in is the amount of buying power you need in your account. So if you do a 10 width spread, and let's say we take in $50 on like an iron condor, the 10 width is $1,000 minus the $50 you took in. Essentially, the brokerage looks like your max loss scenario, and that's how much buying power you need for the trade. Because your max loss would be the $950 or so. Because if you're past 10 points, like if you're at the bought call and it went way past your short, you could lose $1,000 and you did take in 50. So you could lose 950 theoretically. And that's what the brokerage looks at. Because the brokers just don't want to, have any risk in their side. They're going to make sure that they know what the max loss is and then take it accordingly. And that's assuming you're doing defined risk like credit spreads, not undefined like strangles and straddles and all that. That's more advanced. Good questions. You got me on my toes here.
Lance, do you really trade on your phone?
Yes, I do everything on my phone. All of it. They
That's
don't they,
amazing.
they don't let me open up the brokerage on the computer. I can't even open. Last year they did, and then this year the IT department was just clamping down on everything. I can't even look at tradingview.com. Like the only sites I can look at on my school computer are Yahoo Finance and Google Finance. So I could look at just general trends, and those are delayed like 5 minutes or so. So that's not even gonna say much. Everything's on the phone.
Hmm.
Discord's on the phone. I don't even use Discord on my computer. So everything I'm typing is on my phone. And it's interesting, like in the summer when I'm at home and I could use Discord on my laptop, I'm so much quicker. I'm like, oh yeah, I can just type an answer. But on the phone, I'm hacking away. It's gotta roll the punches and deal with what you got. There were times I would bring my iPad in and then do a Wi-Fi hotspot to my iPad. And it doesn't, like I have a keyboard on my iPad, so it's a little quicker, but it's not really dramatic. I'm thinking about getting just a personal laptop, doing a Wi-Fi hotspot from my phone to my laptop, just so I could use Discord quicker. Not even for trading necessarily, because I'm so used to trading on the phone anyway. Like it's more of like Discord, like responding to people. But you don't need a crazy amount of all these technical analysis and EMAs and RSI. You don't really need a lot of that stuff. Too many cooks spoil the broth of the Chinese proverb, right? So, you don't necessarily want to flood yourself with 80 different things going on because then your mind gets muffled. Have a good night, Charlie.
So I come from that technical analysis side. So you are a breath of fresh air, Lance.
Yeah,
I love the simplicity of it.
it could work. I mean, trading, you could do a lot of different things. There's nothing wrong with looking at, 8 to 10 different indicators and then picking, okay, now I'm going to do this. Like, if that's what works for you, sure, there's nothing wrong with that. But it doesn't work for me. I mean, I know all the different technical strategies I know a lot of them, but I don't use a lot of them.
Moving averages and MACD and all that other
Right.
stuff.
Sometimes it's
What's
as simple as you see a stock over here, you saw in the past, it went down here and it bounced up, maybe did it again. It's an obvious support level here. I'm going to look to sell a put credit spread below that. And that's it. Sometimes there's trades just like that, to be honest. And I don't
what's
even
your
bother looking at RSI, MACD, and all that stuff.
what's your track record on the longer trades, not the SPX ones?
Yeah, longer trades. Let's see. I give these out to the inner circle members that are lifetime for everything. It's a spreadsheet of it. From last year, this year, we're at 92% win rate. Last I checked. There's a few trades I didn't enter in yet on the data. It's close to 90 to 92%. and the average return was 3.05% per trade. That includes the stop losses. It just averages everything out. And the average days in trade was 10.6 days. The data last year was pretty similar. I think the average return was like 2.8 or so percent, and it was about 12 days in trade.
Lance, one quick question.
Yeah.
So the in a spread, if one leg it matches with the strike price, what will happen to the spread? It'll completely executed or just that leg?
So let's say you sold I'm just gonna make the numbers easy. You sold a 4,500 put, and then the market goes down to a little lower, 44.95, let's say. At that point, you're down 5 because you sold 4,500. It's at 49.95. You'll be down 5 times 100 because options are involving 100 multiplier. So you'll be down $500 in that case. For SPX, it'll be cash settled, meaning that your brokers will just debit your account. You won't get early assigned or anything like that, and then it could keep dropping. However, with other stocks not like SPX, like if I sold like a Microsoft put, at that case, you could get early assigned possibly, and then you could continue losing money if you're not aware of that. Because if the market keeps dropping, you might get assigned 100 shares of Microsoft stock at that case.
Okay.
That's
So
that's one main reason why we get out of the trades at the 3x stop, because we don't want that stuff to happen. It could get pretty dangerous.
okay. So that's why we need to put the stop loss, right?
Exactly. I've never got assigned on a credit spread since running this in 2021, I think it was. We haven't got assigned one time. So, I mean, that's not saying it won't happen. Because if there's a huge gap, obviously it could happen, but it hasn't happened yet. Even most of the trades haven't even gone way past the 3x stop. Like, let's say you're in, a month-long trade and it gaps down overnight, and let's say you're already pretty close to 3x stop right before that, you would possibly get more than a 3x stop at that point. But I haven't seen many that were dramatically more than that. Like, I don't think we've ever had a 4x stop or so. That's not currencies, like 4 times, not 4x. That was a bad pun. Don't trade 4x, it's really complicated.
So can you get assigned and have a risk that's actually higher than the $500 you have on a stock?
Yes, that's what I was
you can.
saying. Yeah, you
Okay.
could theoretically get assigned early. The only reason why you'd be assigned early is that the other side of the trade might want a dividend in most cases. Like there's an upcoming dividend coming up and they want to capture that dividend. They might early assign it before that. Otherwise, it doesn't make a lot of sense for the buyer because they have to pretty much pay the extrinsic cost of it. So there's still time available in the trade. They're pretty much giving that up for the early assignment. It's very rare. When I was doing cash secured puts, there was only one time, I think ever, where I had Intel at like $50 a share. I sold about a 55 call. So it was a covered call position. And it went up to like 60 or so. Someone called it in just the day before the dividends because they wanted the dividend payment. So in that case, I just lost my shares at 55, but I was perfectly fine with that because I bought at 50. I'm agreeing to sell at 55. That was good for me.
So
Martin's
what
saying,
happens if,
sorry, let me get Martin's question. Have you tried the box hack? Oh, yeah. Excuse me. Teacher voice. I've never done that. Essentially, you have to like do the opposite and you rebuy a different strike. I don't think it's necessarily worth it, to be honest, but yeah, that's a little more complicated. I'm not going to go over that here. Sorry, that was another question that came up before.
I would say, well, what happens if you get assigned on something that you don't have the buying power to buy 100 shares of?
Yeah, it depends on the brokerage, to be honest. Um, I think Thinkorswim will possibly just close you out, especially if you don't have the buying power for it. I think I'm not 100% sure. It depends on the brokerage. They might give you
Okay.
a margin call and tell you, and then you have to manually close it out. But don't get too worried about a margin call. You'll have a day or two to actually deal with it.
Oh, okay.
So I can't
Right.
give a specific answer. It depends on your brokerage.
Okay.
You'll pretty much notice, like you'll see a pretty big negative out of nowhere, but don't freak out about it because you actually own 100 shares of stock. So then you just sell the 100 shares of stock. Is pretty much all you got to do.
Okay.
And then at that, like the only thing that can really hurt you is if it keeps dropping, like right after you notice that, then you'd have to sell your 100 shares lower than where you got to sign or where the price was at the time you got to sign. But all these things, like we almost never, like this never happens to us before because we're stopping out at 3x stop. So we're stopping out before it hits the sold price anyway.
Yeah, yeah.
So
So the only thing would be,
you would need to see a really big gap like down overnight, like way past your short.
yeah, like something like what Riven did,
Oh yeah.
back a few weeks ago or something. I had some of their stock and I'm still holding it, but it just like, it was like earnings and they lost like, I forget what it was, but it was significant overnight. Or Lulu did the same thing, to me
Right.
too. I pick the stocks that like gap down terribly on news.
Yeah. How do I monitor? How close do I monitor a winning trade? One point would be achieving 50% in less than half the total time. That's a good ballpark way that I usually look at it. What I personally do is lunchtime, I look at all my open positions. I see how much possible return there is. Just look at the P&L number, and then just simple math. $500 spread. If you're up 25 bucks, you're up 5% on the trade. And then if I see I'm up P&L 25 per position, then I'll usually alert to close that out. You can do other stuff like that. Like, yeah, if you made 50% of the premium in less than 50% of the time in trade, at that point you're making more per day than if you just held it to expiration. So that's some way to do it. But also you want to make sure you're getting enough premium for it to be worth it. Like I'm not going to close something at like 1.5% or so if it happened in a day. Like there's a balance between the two. I personally look for anywhere from 3 to 5% on an individual trade. And if it happens in, 5, 10 days, you're almost always going to take it because that's a good return per trade. And I can stay for about 10 more minutes. Any other final questions?
On the 5 wides, then is the max you can lose 500, or can it even get
Yes.
worse than that?
Theoretically, it could get worse than that if you got early assigned and the stock keeps dropping. But that's very rare again. And we're closing out at 3x stop. We're very close to that anyway. So, let's say we're selling a 150 put, buying the 145. If it's at like 152, 153, we're probably already out of the trade anyway. So, excuse me. So there's a good chance we're just going to get out before that. That's, however, not to say that it might keep dropping. So that's why you got to watch it.
Doesn't your other position protect you?
It does protect you, but it's up to the max loss. So if you didn't get early assigned, you're right. The max you can lose is $500 minus the credit you took in for the trade. Because again, you sold the 150, you bought a 145. If it closes right at 145, you lost $500 on your sold put because it went down 5. Your 145 is even. You wouldn't have made anything on it. Now let's say it went even lower to say 140. In this case, you lost $1,000 on your 150 put, but you would have gained $500 on the 145 put. So essentially, once you, in a put credit spread, once you hit the bought put option, that's your max loss. Because every dollar you go down on the short, you gain the dollar on the bought. That's again assuming you don't get early assigned. And yeah, again, I'm saying it over and over, but that's why we get out at 3x stops because I don't want to deal with all that stuff.
So as long as you get out of it before it's in the money, you can't get assigned, right?
Pretty much. I mean, it wouldn't make really any sense for someone to get the shares of stock when it's not even at that price already. I
Yeah,
mean, the dividend is one, but the dividend's usually so small compared to the price, it won't matter. Yeah, I've never seen that happen before. The only times I've ever seen early assignment is because of the dividends.
okay.
And you can think about it like if you sold the 150 put, obviously someone else bought that 150 put and they had to pay a premium for that. Maybe they paid, $150 for that particular contract. They're essentially losing that extra time decay that they have to get assigned on it. It makes more sense for most people just to close the actual option and not get 100 shares of stock. Because there's a few reasons. One is they're losing that extra decay. They're having to pay for 100 shares of stock, which is not very buying power efficient, to be honest. Like if you just bought an option for say $150 and it's now worth say $400, just close it for $400. It just makes a lot more
Yeah.
sense. The dividend's really the only reason I can think of. Unless someone really wants that stock. I mean, you never know what other traders are thinking. It just doesn't make much logical sense to do it, to be honest. The times you might see that more often than not, it's maybe the day or two before expiration of the contract. You almost never see it like 2, 3 weeks before.
Oh, okay.
And dividends.
And I jump out of a lot of stuff when it's like at 75% profit. Maybe that's a bad practice, but a lot of them I just close out at like, I'm like, oh, you're 75% of the way there. I'm like on a little burst. I'm like, I'll take my money.
Do you mean buying options for that?
I mean, no,
Just
I'm like on the put credit spreads and stuff. Like I'm
Yeah.
like if they're most of the way to
Yeah,
profit.
there's nothing wrong with that. You get out of the risk. If you already made your 75 or so percent, you get out of the trade, you can't lose if you're out of the trade anymore. Because you never
Yeah.
know, the market could bounce the other way and then you get a loss
Well,
on it.
like today pulled everything I have in my portfolio down. This was a
Yeah.
pretty down day.
Yeah.
Across a whole bunch of different sectors, like I pulled down like $800 into the negative and I'm like, yeah. But
Yeah.
then I didn't panic. I let it sit, I let it ride and it pulled back $300 and I won the SPX, today. So
Yep. It's good to have a lot of different strategies because you don't want, one turn of the market hurting everything.
yeah.
Martin said both PCS, Meta, and Microsoft have earnings. Yes. That would increase volatility coming closer to the date. Possibly, but it's already factored in. So people already know that the earnings are coming out. It's less than 30. It's less than 40 days, by the way. I think it was like 20 or so days. I put it on the alert. So volatility tends to stay pretty high, pretty close to expiration within, around the 20 days or so. Right after the earnings come out, the implied volatility usually decreases quite dramatically because now they have a lot more information about the stock and we already know what the earnings are. So that's called IV crush. Sometimes we take advantage of that by just staying in the trade, especially if we're still pretty far out of the money on them, because if it doesn't dramatically move after earnings, the volatility will decrease a lot, and then we can get out right after that. So that's why you don't want to freak out too much about earnings necessarily. Also, I'm doing an alert every day, so I gotta make sure some of them will just naturally have earnings. I can't pick stocks every day that don't have earnings, in the next 40 days, because then I'll be picking weird stocks that don't even have it. So yeah, don't freak out about it. It's gonna occasionally happen. And it happens about every 3 months because that's when earnings are. But then after that, you get out of it. I got a few more minutes. Any other last questions? All right, I guess we'll end it there. Very good questions, guys. Keeping me on my toes. Any other questions? Let us know in the Discord. Again, I prefer if you write in the chat channels over DMing me one-on-one too much because I am teaching throughout the day, so it's hard to respond one-on-one. And especially if a lot of you guys just joining in. If you ask the group channels, we all learn together that way. So yeah, feel free to occasionally send me the one-on-ones, but just be aware I'm still teaching, so I'm not going to be as quick on them. Thanks a lot, guys. Have a good rest of the evening.
Thanks very much.
All right,
Thank
have a
you.
good one, guys.
Have a good one.
Thank you.
Thank you.